In this video, we will see in detail about the corporate actions. So, under this, we will particularly discuss dividends, stock splits, and the buyback of shares. So, first of all, let's see what is this corporate action. So, corporate actions is a type of process that will bring actual change to the securities, either in terms of number of shares. Some changes will happen in the number of shares that is outstanding, or it may change the face value of the shares, or it may bring about um, even buying back of shares or receiving new shares when there is a merging or acquisition by the company to the shareholders. So this is what will happen in case of corporate action. So corporate actions um, are typically agreed by a company's board of directors and are authorized by the shareholders. Some of the main examples of you know corporate actions are dividends, stock splits, and then the buyback of shares, even rights issues, which we already discussed in the previous videos, and also the bonus issues. This also we discussed. So these are some of the examples of corporate actions. By understanding these different types of processes and their effects, an investor can have a clear picture of what a corporate action indicates about a company's financial aspects, as well as how that action will influence the company's share price and performance. Ultimately, we are actually interested in how this corporate action will change the security price, right? So, first of all, let's understand dividend. So, what is mean by dividends declared by the company? Returns received by the investors in equities usually comes in two forms. One is like growth in the value, that is one value in the sense like market price usually of the shares, and the another one is the dividends. So if I hold a stock, these are the two important returns that I will be receiving. And a dividend is actually a distribution of a part of a company's earnings to the shareholders. It may be usually twice a year, and usually in the form of two things. One is the final dividend, another one is the interim dividend. A dividend is therefore a source of income for the shareholder. Normally, the dividend is expressed on a per share basis. Okay, for one share, how much dividend you are going to get? That's how it is expressed. For example, if we say 3 per share, that means I'm going to get a dividend of 3 rupees for every one share I'm holding. Actually, this makes it easy to see how much of the company's profits are being paid up and how much is being retained by the company to reinvest into the business. So a company that has earnings per share in the year of let's say 6 rupees EPS, and dividend per share, let's say is 3 rupees. This says that the company is spending 50 percentage for reinvestment and 50 percentage for distribution as dividends, because out of the 6 only this 3 is being paid. So however, it is not like every time the company will be distributing dividends, because the directors have the discretion or the power to decide how much of a dividend to declare and how much should we actually pay as a dividend or should we not pay at all. So there is something called dividend yield. Let's understand this thing. What is dividend yield? So dividend yield actually gives the relationship between the uh, current price of a stock. So that is market price of a stock. And the dividend, usually the dividend considered here in this case is the dividend that is paid for the last 12 months. So how the dividend yield is calculated, it is just okay dividing the past year's dividend, that is dividend for the past, okay, 12 months of the particular company. Put this in the numerator, and the denominator have to divide it by the current stock price, the market price. This is how the dividend yield is calculated. So usually the dividend yield, let's take example. If let's say like the share price is 360, and then the annual dividend is 10, then the company is giving a dividend of around 2.7 percentage. Historically, higher dividend yield has been considered to be desirable among investors. So if the dividend yield is higher, then it is very attractive among investors, whereas lower dividend yield is not that attractive. And also, if the dividend yield is higher, okay, then the stock is underpriced. Okay, that is one thing. The dividend is that the stock is underpriced. If the dividend yield is lower, then the stock is overpriced. Ultimately, yeah, due to the higher denominator effect, and then the less dividend in the numerator, so you'll be getting this thing. So obviously, it is because of the overpriced or higher denominator effect. But however, there must be some caution in, okay, understanding this metrics. There are some companies which have declared a high dividend yield and they have gone busted in the later years. So it is not that always the companies, okay, that is declaring higher dividend yield are good companies. So some fundamental analysis has to be made about the companies before going for those companies by merely looking at dividend yield. But however, we could say the dividend yield is one of the factors in determining the future prices or future performance of a company. The next thing, let's see, is stock split. So what is the stock split? It is a corporate action. Obviously, it splits the existing share. Okay, it splits the existing share into smaller denominations so that the number of shares increase. That is stock split. Usually, in this case, what happens is the market capitalization remains the same because we are actually splitting the existing share. For example, let's say a company has 1 crore shares outstanding and it has a face value of, let's say, 10 rupees, but the current market price is, let's say, 100 rupees. So if there is a 2-for-1 stock split, then what happens is the face value of the stock will get reduced to 5 because for every okay, one share will become two shares. So obviously, it's like, okay, every 10, okay, face value share will become two shares each of, okay, 5 value because the face value has to be divided. And also the market price will also get halved, and thereby what happens is the number of, okay, shares outstanding will become 2 crores. However, if you multiply the market capitalization before, okay, pre-split, just multiply this into this, it will be around yeah, the same after post-split. For post-split, multiply this with this. So again, the market capitalization is on the same. So this says a lot. Actually, why the company is doing this type of stock split? What is the reason for doing this stock split? Theoretically, one would say if we do stock split, what happens is your company's shares becomes affordable because the face value is getting a halt. Once it becomes affordable, the liquidity aspect of your share will get increased. So this is one reason why the company is doing stocks. And one more thing uh, is that there is splitting of the stock brings the share price down to a more attractive level. That is the reason. So to make it more attractive, these are the three main reasons why the company is doing stock split. And now let's see the third concept, that is the buyback of shares. What is this buyback of shares? A buyback can be seen as a method for a company to invest in their company itself by buying shares from the investors in the market. So when you do buyback of shares, usually what happens is, the number of outstanding shares will get reduced in the market. When the number of outstanding shares gets reduced, obviously what happens? The demand for the shares will go up, and thereby the market price of the share will go up. If the market price of the share goes up, then obviously the earnings per share of this thing also goes up. So this increases the wealth of the shareholder. That is in fact the wealth maximization concept. So it brings about the wealth maximization concept. So this is one major reason why the companies go for buyback of share. So when they are doing the buyback of share, usually the company will be having high cash or high amount of cash in its balance sheet. So they will invest, and maybe they don't have any alternative to invest this business alternative. I mean, to invest this cash. So they actually buy use this cash to buy securities from the market, from the investors. Usually they pay a premium. Let's say like if the current market price of the share is, let's say, 100 rupees, the companies will pay around 120 rupees and get it from the investors. And thereby what happens is, after let's say like 3 or 4 months, due to high demand for the stocks of this company, the market price will go, maybe it will reach even 150. In a way it is increasing the EPS. So according to the SEBI regulation in 1998, the company is permitted to do buyback of shares from the existing shareholders on a proportionate basis by using the by through offer document. And also they can do the buyback of share in the open market through stock exchanges by using book building process. That's one thing. Another one is they can also uh, take away shares from the shareholders who are having a lot of shares, or maybe to the reason why they are doing this in the third case is because to reduce the control of this particular shareholder. So these are the main reasons why the company will go for buyback. And that's it as far as this corporate action part is concerned in this video segment.